Good day everyone and welcome to Fibonacci levels for best targets and exits. My name is Nenad, Chris is here with me too, and we will present you some very interesting things that you maybe have heard of, but also I'm sure that there is a lot of people who simply have never heard of these things. So it could be useful to use it in your trading habits. This is something that is what I will be presenting you. Chris will present you different thing. He'll present you Wiz tool, but I will focus on some patterns that have not been developed personally by myself, but actually those patterns were developed by other trader. I will of course mention him because it is his work, and so far my testing has shown some nice credibility in these retracement patterns. As you remember, I already promised that I will show you that, like, I think I promised it like 2 or 3 months ago, and I did some testing on these patterns that I will show you, and results so far have been promising. So let me first go with this disclaimer and then we can proceed. So this is me, this is Chris, and CFD and Forex trading are leveraged products and can result in losses that exceed your deposits. This presentation and the video is for informational and educational purposes only. And the video is not part of the .co.uk website, but the globalnews.com website. So please read the full risk disclosure on this web address. So these are exclusive retracements that I will show you. There is 4 of them. Okay, so there is 4 exclusive retracements. They're called IPs originally, and I will show you live example. So first I will mention the work on these patterns has been done by Viktor Pershikov. He is a Russian trader. He also he is well known in trading community, and he basically introduced internal patterns like IP 1, 2, 3, and 4 on IFTA journal in 2014. I know that he also had his website. I don't remember the name, but he basically worked on these retracement patterns. He also published a book. So basically, these patterns are his work. So I need to tell that those are not mine. So it's always, we always need to mention the author because we don't want to steal anyone's work and, of course, copyright. So I actually was interesting to see, I was very interested to see what he actually has to offer because I like Fibonacci's, and you know that my favorite is 88.6. So I took a deeper look into his book and his work on that was published on IFTA journal, and so far I might say I like this. It's an interesting approach, and so far it has some consistency and validity. But of course, Fibonacci patterns are always a bit subjective, so there is a disadvantage, but it's not disadvantage because of these patterns, but actually to drawing Fibonacci ratios, because you will see when I get to a deeper explanation, you will see why I think so. But definitely this is a good thing, and I like it, really. I like it. I need to say these patterns are valid. They hold ground. And if I didn't mean that they hold ground, I would never tell you this. So let's start. IP1, it's 23 point. These are levels. I will go step by step. So first, memorize these levels. 23, 6, 9. This is stop, this is target, and this is reward to risk ratio. That can be 4.6 to 1. Now, maybe this does not ring a bell to you, but when I open a real chart, you will soon see what I'm talking about, and it will be all clear when I start to draw these Victor's patterns. So, yeah, here it is. I mean, I know that there is a lot of good traders in Russia, and unfortunately, Westerners don't have a big insight into Russian traders, but I really need to say that there are many good traders from Russia that I know, and I know also I met some of them, and they do good work. But you know, in media, it's a different language and different syllable. They use different letters, so you know it's not, and different alphabet. So for Westerners, it's not very common to understand Russians, but I can understand it, and honestly, I need really to admit that there are many good traders that can be found in eastern parts of Europe and Asia, and that is Russia indeed. So this is what I have come to conclusion regarding these patterns. So guys, if you don't know how to chart this, well, I will show you. So first you need to put a Fibonacci tool. Okay, so Fibonacci retracement, you go here, insert Fibonacci retracement, and then of course you always plot from left to right, from past to present. Why? To give you the future outcome. We already talked about, so everything is clear, right? Now, what is interesting, these retracements have been added. Okay, I will remove mine 78.6 and 88.6 from these calculations, and I will strictly focus on Victor's patterns, okay, IP. So if you go to objects list here, and if I actually remove my favorite patterns, retracement, sorry, 78.6 and 88.6, well, now we will be given only patterns that are used in IPs, or internal patterns. So in order to put 9% of retracement, you need to enter 0.09 like this. If you want to put 14.6, you need to enter 0.146 or 4 in 6. Okay, so then at the description, do it just as I did here. You have 9% dollar sign, 14.6% dollar sign. When you click OK and close, you will actually see this on your chart. Now, what means L1, L2, and all these patterns? Okay, this is where it becomes interesting. So if L1 is 23.6 and L2 is 9, it means that the price will get to 23.6, okay? Then it needs to hit 9% and reverse. And everything is the same regarding the structure. So this is IP1, 23.6, 9. Okay, this is IP2, 38.6, 14.6 entry. So it needs to get to 38.2, then it needs to get to 14.6 and reject. Okay, so I will repeat this again if anything is not clear. Then we have, I forgot to put IP3, but I will do this. So then there is, the final pattern is IP4. It's 61.8 at 14.6. So the price needs to hit 61.8, okay? Then it needs to get to 14.6 and drop again. I will write down these patterns, and now I will actually add. So I will add this IP3, that is also important. So, and then I don't know why it didn't show up. I was sure that I have added it here, but yeah, now I will do it. Okay, so we have IP1, IP2, IP3, and 4. This is IP3, okay? Just give me a few seconds and I will be fast with this and we'll show you the screen. So IP3 is, okay, so IP3, this is IP3. 50 retracement, 23.6 entry. So what does it mean? Price needs to get to 50, then retrace back to 23.6 and get back to the exit position. In this example, we can see the IP1, because IP1 tells us that the price went from final top, okay, that is always 0, it went to 23.6, but watch this, it hit 9 and then started to reverse. So that was IP1. Level 1 is 23.6. It needs to reverse to 9 and then it needs to, in this case, drop. Stop is 0. Okay, so you place stops above 0 and target is 50%. So in this case, our entry would be here, our stop loss would be here, and our exit would be here. So if we went with internal patterns, as Victor showed up, as he showed us how to do it, we would have made 93 pips and risk would be only, let's say, 30 pips. You see, I mean, it's very, very good study. I wasn't able to see these internal retracement patterns before. So when I actually went deeper into this, I saw that there was some, well, there is a solid ground for maybe a development of a trading method or a system or something that is based on this. Also, guys, I mean, you can do it like this. For example, here, you can also see the price has hit 23.6. Watch this. It rejected to 9. It failed to go up below, but still it was a good rejection from 9% of retracement for 46 pips. You see, it's very interesting to see how Victor calculated this. And also here, price hit 38.2. No, originally, because we always go with the first hit. So the first hit was 23.6, but the price actually failed to hit 9, then it proceeded to 38.2, and it rejected to 23.6. But still, it is valid. You see, now the only drawback of Fibonacci retracement charting is the big unknown, whether the price will continue to go up, like in this case or in this case, and when will it start a full drop, a full swing. So that is what, of course, needs to be done in order to fully incorporate this kind of method into the trading tool or a system. But so far, results have been very, very good by back testing these retracement patterns. For example, we can see this is, and now I'm not cherry picking. I'm just doing charting it randomly. So you can see here the price rejected for 23.6 and it hit 9, then rejected. You see, there is big validity, guys. Okay, it's IP1. So reaching 23.6, then going towards 9 and rejecting. Please, guys, if it's not clear, just ask me. I think it should be clear. Okay, you see, 23.6, then 9 and rejection. What I have seen, I don't know if Victor does it as I do, but what I have seen is that the first rejection is always most profitable. It's very similar to my Camarilla MACD method that I show you on live webinars and session recaps. You know what I always say, the first rejection is the most profitable. That is why big money is always early in a trade, and we want to follow big money. We don't want to follow retail traders, right? So we at least how I teach you to trade is to follow big players. And again, this is a good point from Victor. I think he would agree with me that the first rejections are the best. So you see here, there was a rejection and the price rejected from 23.6, but it needs to hit 9. And it hit, and the 9 was hit here. You see, this is the time when you make your entry. This is the final target. This is your stop loss. But of course, because markets are not that predictable, you cannot say it will go 100% towards our target. You need to protect the target. That is why I would always protect my target if I see that some level of support, like in this example, is not breaking. So if I see a lot of rejections here, I would probably move my stop loss here and enjoy the ride. Okay, we can also find other retracement patterns. Let's say, I don't know, I mean, we can try to find it. I mean, there is no set time frame for these trades. You can use whatever time frame, but I think that he used mostly H1, H4, and I saw some M30 charts also. So for example, let's use okay, this was a big swing here, so let's use, for example, this one. Okay, I will put it, and maybe we will spot other patterns too. For example, you see here, this was okay, it went to 50, okay, to 50 here, okay, so here and here, you see 50 rejection. When it gets to 50, it's the IP3, okay, so it's IP3, level 1 is 50, then it needs to get to 23.6, stops above 0, target 61.8, okay, so this is IP3, okay, it went to 50, it rejected to 23.6. It was not a big rejection, but still, you see, the rejection was respected for some 16 pips, and then it proceeded with the trend. But watch where rejection happened. Again, around 23.6 and 14.6, and 23.6 should have been the entry. Okay, so you see how it can be very, very, very nice. Even here, if we put a stop loss that is slightly higher than originally presented by Victor, I think we could be successful with these trades. Let me see this example. So it went to 23 and almost 23, you see, and then it went to 9, but watch rejection. So if we made a stop here, not 5 pips, but slightly higher, it would have been huge profits. Although the price needs to hit precisely 23.6. But at this example, it was shy for some 3 pips. I would probably say, I would have said probably that this was a good rejection. Because for me, usually I give price a buffer of, in my POC zones, it's 15 pips. For this, we can give it a buffer of 5 pips. And here, the entry was here. Stop loss should have been placed higher, but watch rejection, guys. It's huge. You see these patterns are working good, I think, but they need refinement. Watch this, for example. Again, wow, 61.8 rejection, right? Let me zoom in. 61.8. What is that? 61.8. It's IP4. 61.8. It needs to get to 14.6. Okay. Did it make it? 14.6. Indeed. This was the entry. And watch this drop. Wow. So really, congratulations on this, Victor. I think these patterns are very, very good, very valid. And definitely my opinion is that they should be worked on, and they need refinement. So how big should be retracement? Where should we put stops and so on? I mean, I can do it myself if I get deeper into this, but still, picking the right retracement is something that should be worked on. There is actually maybe a tool that could spot retracements, and it's called ZigZag indicator. But again, ZigZag is an indicator. So we still need to know what are the best settings for the indicator itself. So let's say that we put a ZigZag. Okay, I will put a default ZigZag here on the chart. And I will show you here. Let me just, now the screen has been switched. So here guys, this is ZigZag, and inside its settings, we need to make it correct. So what is the correct setting? I don't know. I still charted these patterns manually. I haven't used ZigZag myself, but definitely I think the only indicator that can be good to automate this approach is a ZigZag. So these settings should be messed with. So guys, if you have time, you can always try to do it based on the premise that I just showed you. You can do it yourself, and then you can send me your insights. Maybe we can find a ZigZag that is good for this approach, and maybe there could be some strategy that can be also automated by using these internal patterns. But so far, as you can see, I've been testing these guys and it looks good to me. For example, we can take this zigzag swing. Okay, so this is swing from the low to the high, you see. Now the price, let's say it has hit 38.2. Okay, 23.6 was hit, but then the price didn't reverse, but actually it was very close to 38.2, couple of pips. And then what is 38.2? It's IP2, so it needs to reject from 14.6. Okay, 14.6. Did it reject from 14.6? It did. Okay, stops go above, and watch this, huge rejection. You see my point. This is a good approach, but it needs to be refined. Which kind of retracement we should use? Obviously, if we used, let's say, bigger retracement for this, we would have had 23.6 rejection, and then the entry would have been here. Now, if we used a complete retracement, again, we would have had 23.6 and 9. So which kind of retracement we should use? That is the question, and this is something that has really, I think that Victor tested this for many years, and actually he wouldn't have published the book or whatever if this method wasn't tested at all. So I think that it still holds ground and that can be worked on, so use it. I will go through slides again. You can snapshot it. This webinar is recorded and will be uploaded, so you will be able to use it too. So don't hesitate to try to search for settings, different settings, and just send me an email, and I will also take a look and see if maybe I can also further research these internal patterns. So IP1 is 23.6, 9, 0, 50, and potential profit to loss ratio. IP2 is the price needs to hit 38.2, then it needs to reverse to 14.6, stops here, target 61.8, and of course profit to loss ratio is higher. You can, my advice is to use stop that is higher than 0, because you saw some examples that price actually reversed after it broke to a stop. Level 1 here, 50, you see entry here, stop here, target, and profit to loss ratio. And finally IP4, price needs to hit 61.8, then go to 14.6, that is the entry, stop is 0, target is 61.8. Okay, so interesting premise. I like it really, and you can work on that. Also guys, I wish to thank you for your comments regarding euro-dollar trade. We made nice profits with euro-dollar longs from live webinar. 1.1660 was our entry by Camarilla MACD method that I always use for my live trading. So thank you guys. If you have any questions, please do not hesitate to ask me. Send me your insights regarding retracements, and Chris will continue now. Cheers guys. Talk to you soon.
Thank you so much, Nenad. Great stuff. Interesting strategy or interesting material there regarding fibs. I'm also going to talk about fibs, of course. Let me share my screen first of all, and we'll be talking about other types of targets. All right, there we go. Just sharing with you the correct screen. There we go. So you should be able to see now fib target. So not much. I wanted to take a look at the live charts, but 2 slides I wanted to share with you. I use basically a combination of 2 fib approaches for tackling targets. Basically, I'm looking at fib targets minus levels. So what I do is actually add minus levels to the Fibonacci retracement tool. That advantage is that basically you have retracements and targets in one tool. So you don't have to draw 2 different things. You can just draw the retracement on the main swing. You'll see price go to the retracement level, like here, for instance, going to the 50 fib, and then it will drop to the minus 272 target, although the minus 272 target is just out of picture in this particular screenshot. But if you take a look at the pink or orange fib, you can see here, for instance, price stopping at 78.6 fib and going up to the minus 61 and then later on to the minus 100 target, right? So it's cool because you have everything in one go. That's efficient and saves time. Very interesting, very simple. So I use these three targets as the main targets, but price can exceed and can accelerate past that. You see even the minus 161.8, the minus 200, the minus 261.8% target. Now, those are possible, but of course, less likely. More often than not, of course, price will is in correction or there's some momentum, but it hits resistance. So typically, it's not going to accelerate all the way to these targets. But occasionally, yes, it will. So this is one thing. I use a combination of retracements, combination of fib targets, sometimes even multiple fibs on different swings, different time frames to come up with basically the most likely point of confluence using these fibs. The more confluence, the better. The more likely that price will basically be attracted to that as a magnet, attracted to that level. The second thing I wanted to show you is, as Nenad already mentioned, my Wiz tool, which is based on Fibonacci sequence levels, plotted as pips from a starting spot, from a top or bottom. So rather than using the ratios, we're actually using the Fibonacci sequence, the sequences themselves, as values of pips. I have talked about this in the past in live webinars, in educational webinars too. I just wanted to review a more practical way of combining both fibs and Wiz in one shot, because that I've never done. I've only talked about them separately. So wanted to discuss a bit about joining them together. Just quickly though, the Wiz levels, this is a 1 hour chart, plot sequence levels. So the first one on the 1 hour chart is the 55 pip. So the pink level is the base, is the starting spot. Then 55 pips away from the starting spot is the first Wiz level. Then 89 pips from the starting spot is the second Wiz level. 144 is the third. 237 is the fourth. Let's see, and then 237 plus 3. I'm getting my fib sequence levels mixed up. It doesn't happen to me often. 55, 89, 144, 237, and no, not 237. I'm 233, 377, if I remember correctly. And yeah, those are the number of pips. So as you can see, though, logically, just to forget the numbers for a second, is that the further you get away from the starting spot, the bigger the zones and spaces become. And basically, there's a higher chance of price moving impulsively and to the next sequence level when you get further away from the starting spot. In most cases, the magic kind of level is the third one. In very fast-moving pairs, it's the fourth, like the pound yen. Once price breaks below or above the third level, that's when we can expect momentum. And that's also where we have the most space, to the fourth, and fourth to the fifth, and even sometimes from 5 to 6, as these yellow zones indicate. Those are, and we could potentially scale in trades in one or scale out and scale in. Trade 1, trade 2, trade 3, like a snowman. So that's the beauty of using that, because you understand when you might be able to aim for a larger target. When do you know when it's appropriate to aim for a bigger target? Difficult, right? This helps. This helps me aim for a larger target. Know when I could aim for a larger target. Helps me also then therefore manage to occasionally get a bigger reward. And the slogan is often used, let your winners run, cut your losses short. Well, with regard to the first, letting the winners run, this tool helps. Cutting your losses short, that's a different topic again. And we have trade management webinars on YouTube that you can find about that, how we use tactics for that. But that's, again, a different thing. So this is great for letting winners run. One more thing before we dive into live charts, though, is the WIS tool is restarted when the price hits the long-term moving average, which is the 144 EMA close. As soon as price hits that, the old WIS tool, the old WIS starting spot is invalidated. So we need to, it's reset. So as long as price hits the 144, but moves away from it, right, we can still use that same tool. So before I dive into the live charts, Angel is saying that he uses WIS and that he likes it, let's see, a lot. He uses WIS a lot, sorry. It's really good, and he recommends it to everyone. So if you want to have it, it's for free. It's a script, not an indicator. Send me an email if you're looking live, or the webinar, doesn't matter, of course, but if you're looking at the webinar, it would be handy if you paused it right now, just to write it down. Sorry for that manual. It's a bit inconvenient, I know, but then again, it's just a quick note, and you have this cool script. If you're looking in the live webinar, I'm sending a message to you now with my email, and you can copy it probably. There are different time settings, indeed, for WIS. 1 hour chart is a different, you'll have, this is all automatic, by the way. All these levels are automatic. The script does that, plots it automatic. The only thing you need to do is choose the right top or bottom, the one that's closest to the 144. And with the trend. Yes, the 1 hour chart uses different levels. It uses 55 pips as a starting spot. The 50-minute chart uses 13 as a starting spot. Actually, I wish I would have made the script use also different levels for the daily chart, but I didn't. So unfortunately, what you can do is manually ignore on the daily chart the first 3 levels, of the first 3 purple levels, and consider the 4th as the first one. All right, let's take a look at the live charts now. All right. So some targets. Let's talk about some of the live charts we're looking at the live trading room, right? So for instance, on the pound dollar downside, let me get rid of these old, this old fib for the moment. And let's take a look at this particular zone in here. I said Monday that this zone, if it breaks, we could have a breakout to the downside. So what is the target? Well, we can put a fib from here to here, for instance, and you can see that there was a 38.2 fib. Now, how do you know which fib to place? That's, again, unfortunately, a bit different topic. We would need an hour just for that, probably. Thank you, Angel. The recording, it will be available, so if you're just curious about how to combine it, you can still look at that. And talk to you soon. So have a great weekend. So with regard to the 38.2 fib, you know, why I use this one is connected to the waves and wave analysis. But, you know, everyone has different ways of using fibs. But generally speaking, this is kind of, in my view, or we could even put it from here to here. Right? This is like one push from a wave perspective. Okay. So anyhow, 38.2 fib, what's the target? Minus 272 target, and the minus 61.8. Right? So those are targets that we can use. First one got hit, second one hasn't. If we add the WIS tool to it, we'll get confluence. So let's do that right now. Let's go back here and put it on the top that's closest to the target, to the long-term moving average. That was first here, then it had to be moved to here because price hit that level. So let's use the most recent one. Click sell for downside targets. All right. So we see that prices hit the first, second, and third level. It's below the third. So it is an impulsive part, and if you know, there's a good chance for it to move down to the fourth level at around 128. And that's what I said as well, that yesterday, that it's a bearish structure, that this could be a correction like this, and I think it still looks bearish. This looks like a break, pullback, continue. Now, it is quite choppy. It looks like a bear flag, so trading, you know, in the middle of the bear flag is not a great thing to do. But technically, I think it's a decent setup despite that. And I think there's a chance of price going to the 128 where there's basically the sequence level and the target. So there's about maybe 80 pips left, 75 pips left there. And I think that could be a good target to aim for. The break of the flag, hook back, continue, but that might be only a very small trade, right? There's about 50 pips upon the break, pullback, continuation. Maybe. It's a small trade. So the target is very close, which means that this breakout is very risky. Therefore, hence, either the trade is taking down this very small time frame or entirely skipped. That's the conclusion. So, of course, if price were to break above 129, then the downside is not valid anymore, and there's probably going to be a bigger correction. Price will hit the long-term moving average, and those things can happen, right? You never know, for sure. But at the moment, it looks bearish, and as long as price stays below this, it looks like it should continue lower. We can take a look at the euro dollar. With the euro dollar, I was a bit more unlucky. Nenad had a great pick at 129.60. I myself was a bit surprised because lately I don't have many times that I feel like my wave analysis is off target. In this case, it was. I saw a 5 wave, and that did not pan out. There was no ABC correction, and it actually did break this bottom. So that particular setup did not work out for me, but ultimately I think that the overall structure is still choppy and corrective, and hence I think that the analysis is still valid for wave 4. So I think it's still bullish, and I think that a break above this channel will still lead to a good breakout for wave 5. So I think the analysis is still valid. It's just that this particular bounce was not the beginning of an uptrend. Maybe this one will be. We'll find out. It could be, looking at the current motion. So yeah. So sometimes fibs get invalidated. In this case, I had this fib on, and it did break to the bottom, right? From a WIS point of view, there's not really a good spot because price is oscillating around this moving average. So there's not really a good moment to place it at this point. I did talk about the dollar yen too. Oh yeah, wait. The dollar yen is all the way at the end. 1 second. I deleted that one by accident yesterday. There it is, finally. I'll move it forward, so good. So yeah, with the dollar yen, I said yesterday here that, basically it's finishing a 5 wave. We can put a fib from the very bottom to the top, and we can wait for an ABC correction in this zone back to one of these fibs, right? Probably one of the deeper fibs, like the 50.61 or 78.6 fib. That has entirely happened indeed. So depending on how you trade it, there could have been a reversal trade to the downside, and then your target would have been the 50 or 61.8 fib. Both targets have been hit. The other option is trading basically the wave B right here, waiting for ABC. Target has been hit, or you might be aiming even for the 78.6 fib. In that case, the target is still open. So this is how you can use fibs, right, to your advantage. Like this, 50 fib, and you might be still aiming for this confluence, potentially. Could move it to break even and wait for that target, hopefully, to get hit. Might hit, might not. Who knows? You never know. But fibs do offer great ways to trade. They do work better in conjunction together with fibs. With waves and patterns. Now, I'm not saying that it's a must. You can trade fibs without them too. I do think there's a benefit to use it with AO, with an oscillator, with understanding momentum correction, with using patterns, wave and chart patterns. It helps, in my view. So what is it? So this is how you can use targets to understand what levels to aim for. Let's take a look at what else can we look for. Pound odd. I was talking to a friend of mine today. How to treat the pound dot, right? And he was analyzing a short trade setup that he didn't take because he doubted, but had some doubts about the setup. But we were talking about targets in general, so we were, analyzing like what would be a good target if he would have entered today. So basically, what you can do is take a look at, of course, it doesn't hurt to take a look at the bigger structure like on a 4-hour chart, right? What was the most recent swing? So we could put a fib from here to here. The main target of this 4-hour chart after the 50 fib bounce is the minus 272 target. That's still open, right? After that, the minus 61.8 target. But only after the minus 272 target gets hit. So the first trade is down to the bottom. Then if that breaks, down to the target. And if that breaks, down to the minus 61.8. Then further, right? Take it step by step. That's one of the fibs we can have. We can also put a fib on a smaller swing, like an hourly swing, from here to here, like this, right? And we can see the price was, we were looking at it this morning, so it was close to the 61.8. It was about here. And we can then zoom in to, for instance, an hourly chart and use the whisk tool. The whisk tool is handy, especially if price has moved away from the moving average a bit, right? At least 100 pips or so, it makes sense to use it. So let's use this top, looking for downside targets. So as we wait for this, oh, good, there it is. So level 1, 2, level 3. So that's when we can expect more movement, right? So as soon as price breaks through the third level in the S1, we can expect it. Look at this zone right in here, right between S1, S2, and the third and fourth level. That's exactly a sweet zone where we can expect price to continue. And then where's the next zone? Well, below the fourth and the S2, down to the fifth, the S3, and the minus 61.8, right in here. That's the second zone. Isn't it beautiful? In my view, it's almost like art, right? I really love looking at confidence like that. It gives me confidence in my trading. I've seen it repeat day in, day out over years and years, and I can't emphasize more how important I think it is to train in fibs and in fib sequence levels, because they're such a support. They're such a great way of looking for targets. I think it's the best. There's nothing that can beat, in my view, the value that fibs give in finding exits, especially when looking at targets in combination with where is the space by using sequence levels. It's difficult to match. So let's take a look. The trade price was already here at the time. So it was basically, it was about 100 pips away from the target, the main target, right? But there was also 162 level to reckon with. So, 75 to 100 pips. Still enough for a lower time frame. Not on the hourly chart. Why? Because look at this move down, right? It was too impulsive. For an hourly chart trade, we would need to have a bear flag and then a break. And we can take the turn at the bear flag or the break of the bear flag, put the stop loss above it, and aim nicely for this target. Good R2R trade, nothing wrong with that, makes sense. But now if price is going sideways like this without a bear flag, it's not good for an hourly trade, but it could be good for a 15. So we were reviewing the 15-minute chart, right? And my system gave an entry somewhere in here, right, with the stop loss above, aiming for that 161.75 area, right, with knowing that 162 could be bounced perhaps with an even level, but 161.75 was the main level, right? So the trade worked out fine, right? This very close to hitting the target, 161.90, with proper trade management. The exit should have been somewhere around here, trail stopping this candle high, basically. So maybe 40 pips. Not as many as the 100 or 75 that seemed likely, but not bad either, right? And why? Basically because this was a correction on the 15-minute chart. There was still space left. Downtrend was available, of course. Will this type of setup work out every time? No, it won't. But the odds, I think, were in favor of this kind of last push in this zone. And the fibs helped with recognizing, you know, and finding that zone, making it visible. So yeah, you got to draw 1, 2, 3 fibs sometimes. It does take some practice to know which fibs. The Wiz tool is pretty easy. The Wiz tool is actually less discretionary than the fib itself, because you just need to find the long-term moving average. You need to know if price is above or below the long-term moving average, and that's it. Right? There's no, should I use that swing? Should I use that leg? No, none of that. So from that perspective, it could make sense to base the first step on Wiz, on the sequence levels, and then add fib targets to it. So that's my part for today. Thanks so much for joining. We got, of course, more webinars coming up soon. If you're interested in this particular tool, you can reach out to us here through my email. It might be easier because I can send it to you directly, or of course Admin Markets. Feel free to sign up for more webinars, and of course check out the YouTube, Facebook of Admin Markets. We've a lot of analysis and other information about trading, cryptocurrencies, CFDs, commodities, Forex, you name it. We got crypto webinar coming up, so you might want to join for that. AdmiralMarkets.com. You can find out more information about other indicators such as the MetaTrader 4 Supreme Edition with 60 extra features. So hope to see you soon. Wish you all, above all, great trading, and cheers.